All right, everybody. How we doing out there? Doc Severson with you here. 10X Tribe coaching on Tuesday, the 23rd of February. Welcome aboard, everybody. Glad to see you could make it today. I will be taking your questions at the end of today's session. We'll try to keep this to a fairly tight 30, 40 minutes or so, depending on how many questions that you have. I have two questions that have come from our elite members today, which I'll be going into. And we actually have another session for Elite on Thursday evening as well, too. So can't get enough of this stuff. All right, so we have markets are actually recovering today. We had a little bit of a mini panic crash, and I'm not sure why. It doesn't really matter why. Everybody's going to make up a reason or excuse as to why it was. Chances are that there was a little bit of fear of the Fed coming in. We have rates that have been going higher lately. And if rates go higher, they haven't been going higher in a long time, really, since the end of, I'd say, 2018, since we saw rates actually rising. So this is a little bit of a strange market for people. And we've been basically on the tear since the bottom, which was about 11 months ago. So a lot of, you can think of this market right now as a very heavy weight being balanced at the end of a long, skinny pole. It's able to do it, but if you have any instability in there, the whole thing can come crashing down, which is why everybody is a little bit tenuous today. And we're seeing a little bit of fear. And so this is good. I think markets climb the wall of worry, and this is what we need. We need one final push to the upside. And we can go into some market theory later on if we want. Okay, without further ado, let's get started here with some of the questions that we have. If you guys can hear me, let me know. Give me a thumbs up. Let me know where you're coming in from today. All right, so the two questions on board today are approaches to setting targets at all-time highs. Now, the way I understand this question, or the way I'm going to interpret this question, is markets that are going at all-time highs, and we're seeing this today. I mean, the market is just a little bit off. It went down less than 4% over the last 5 days, but you'd think that reading social media that we are in a crash. In fact, I got into a debate on Facebook today, like somebody saying, this is a huge crash, and I'm like, no, it's not. It's 3.9%. This is nothing of the sort. Right? So I think once in a while I have to get in there and roll up the sleeves and throw down the dukes, because this is not a crash, guys. This is not a, hey, there's Ray, and I think Ray is coming in from Charlotte today. Good afternoon, Ray. Good to see you. So approaches to setting targets at all-time highs. So a target meaning, at what point do you thin out the inventory? At what point do you thin things out, or maybe even go to cash? So I'll talk about a couple of things. And actually what I do want to bring up is that I just finished, it was funny because I just finished a section today of the new course that I'm building for the 10X Tribe for the Elite, which is about portfolio protection. Haven't named it yet, haven't broadcasted or published it yet. Want to get a couple of sections in the can before I open it up to the elite folks, but it will be coming shortly. So that's going to be the first thing that we talk about today. And then number two is, I just got this question about an hour ago. All right, Anthony coming in from Northern Virginia, and Crypto Cube, which I think, if memory serves right, you're from the People's Republic of California. Right? Isn't that behind enemy lines in Los Angeles, something like that? California. All right. So the second question is, can you provide the reasoning why you would want to enter cash secured puts on a pullback? Now, I realize not everybody knows what a cash secured put is, so we'll give a little background on that first. And we got the Forex codes coming from Blackpool, UK. Fantastic. Just talked to him offline. Blackpool is one of the places I'm putting on my list next time I visit the UK. Definitely. Okay. Why would we want to enter cash secured puts on a pullback? Why on earth would we do something like that? So we'll get into that as well too. All right. And of course, if you guys have any additional topics or questions you want to bring up, we'll go as long as you want to, but generally I like to keep these things tight and, limited to maybe 30, 40 minutes or so. Otherwise, it gets too long, and people that are watching the replay, they have to listen to me at, chipmunk speed and things like that to get through it. So want to keep these things tight. Or rather do more of these than fewer, longer ones. Okay. Question number 1, submitted by Andy from Dublin, Ireland. Some potential topics. Number 1, approaches to setting targets at all-time highs. And how do we do something like that? All right. First thing I want to establish is it's nearly impossible to know when the actual market high water mark is. I've been doing this for a long time now, and I've yet to nail a top. And it's not just because I'm not that good. It's not just because I'm human. The way that market tops are created almost makes them impossible to find the exact high water mark. It's not like the market goes out there and rings a bell. Hey, I'll let you know when it's the high. No, it's not going to happen. The very fact that they are extremely emotional, it's all this emotion of fear of missing out and fear of loss and everything like that gets wrapped up into a market high. And by far, I actually would prefer to spot a market low, which can be even more emotional where we get into waterfall declines and things like that. The price action actually does move faster to the downside, but there's something very, very important you need to understand. I want you to remember this, write this down, stick it on a Post-it note, do something with it, okay? Trading is a lot of these little bites of knowledge that get passed along from person to person. It's my job to pass this along to you right now. So write this down. Tops are a process. Bottoms are an event. So in other words, a market top is going to be something like this. Generally, not all the time, but a market top is going to be a torturous affair where you don't really know where the actual top is. Whereas a market bottom is going to be an event, and especially lately. And when I mean lately, I mean over the past 11, 12 years. That's lately. We've had very spiky, single point event market bottoms. Tops are a process, bottoms are an event. And as long as you keep that in mind, you'll probably do okay. Because there's ways to spot the event. An event being a one-time thing, we can use things like divergences. We can use smaller time frame price action through the market fractals. There's lots of different ways that we can pretty confidently spot the bottom, as well as the fact that we get a big advantage when we use options that will get this massive spike in implied volatility, which we can work with. So we don't have to be right. We can just be in the ballpark and we can still do pretty well with market bottoms. But market tops, man, they're a bitch because you have the market, and this is unusual because we still have a VIX over 20. Most of the times when we're in market tops, we're at a VIX of less than 15. It can be 10, or it's been in the single digits over the last few years near market tops. Makes it extraordinarily difficult because the risk premium is so cheap that you can't sell anything. You've got to be a buyer of options at that point. We're not at that position yet. We can still do quite well being a seller. Okay, so hopefully I've made that point. It's nearly impossible to know when the actual market high water mark is. It's impossible to spot the top. You're going to see all sorts of online marketing from folks that are these great wizards that claim to have nailed the February 2020 high. But the problem is these guys are putting out predictions about every other day, some high, some low, right? So sometimes conflicting with each other. So eventually they're going to get one right. And it's really rare to see somebody in public putting out the same projections day after day after day, which are consistent. Now, I don't do that kind of stuff. I don't sit out there, and I'm not an attention whore that's out there trying to publish predictions every day, even though that's what people love to see, because it's useless. It really is. I would rather just deal with what's in front of me with the price action and understand what the price action is doing. And if I see something really serious, I will say something about it. But my signal to noise ratio is pretty high, I'm hoping, because I don't spend much time predicting what's going to happen. I think that's a fool's errand. Sometimes these guys are wrong for years, and then they still claim that they predicted the top, because if you're wrong for years, all of a sudden you're right. And I've worked with guys that are like this, that are 100% bearish all the time. And then on the off chance that the market actually goes down, which occasionally will happen, all of a sudden they're celebrated as being a guru. And it just makes me ill, right? It just doesn't do anybody any good. Even a stop clock is correct twice a day. So the point that I'm trying to make to you guys is forget about predicting the top. Forget about listening to people that are trying to predict the top, because what's going to happen to you, it's going to do the opposite thing. If you find somebody's prediction that you align with and say, I like that prediction, I like that person, he delivered that point with conviction, and I really believe in that person, you've just inherited what's called confirmation bias. Confirmation bias is one of the worst things that you can have in trading, because what it will do, it's almost like putting on horse blinders, right? So the horse can't see the other horse next to them. That's all your brain will look for, is confirmation of whatever this clown was predicting. And your brain will be put on an errand to go seek and find anything that confirms what they were talking about. You see the same thing. I bring up this example all the time. You see the same thing. If you guys have ever gotten into something brand new, like when I got into motorcycles 15 years ago, all of a sudden I saw them everywhere, right? My brain was tuned into motorcycles, and it would fine tune my senses specifically to filter out anything to do with motorcycles. Oh, there's one over there. Oh, there's one over there. And the same thing will happen if you, for instance, want to buy a Dodge 1500 Ram. All of a sudden you're like, man, I've looked at all the consumer reports and I really want to buy this Dodge 1500 Ram pickup truck. You will see them everywhere. And that's the way the reticular activating system works in your brain. This is called confirmation bias. So confirmation bias in trading is deadly. It's absolutely deadly. Remember, trading's not that hard. We just, buy low, sell high. When things are going higher, you generally want to be long. We make it difficult on ourselves. We invent all kinds of mysterious little stories that we play out in our mind. And you have to rid yourself from it. It's something I have to work on every single day. Human beings are not built from the factory to be able to effectively trade, because we have all these cognitive biases that will lie to us. So that's all I'll say on this topic, right? So I just say, be careful about who you listen to. In fact, the more I do this, the fewer the people that I actually will listen to on a day-to-day basis. That's why I come in here and say, hey, the market was down today. I don't know why. I'll find out later, but I don't want to know right now, because I don't want to poison myself by getting a confirmation bias. So here's the deal. Just do the best that you can within your current skill set to manage risk. That's what you're trying to do. That was the basis of the question, I do believe, is to manage risk. How can I do the best job I can do to manage risk of my portfolio? If I have a long portfolio like 99.9% of people out there, what can I do to manage the risk on that portfolio? So again, that's why I'm building this class, because it's something that everybody is front and center on. Nobody was asking me about this back in March. It was already too late, right? You got to play defense during times of peace and not war. And right now is a time of peace. Markets are near all-time highs. So there's two things that I'll share with you today, which I won't say are perfect. Never going to say that they're perfect. I'm never going to go back and say, we timed the exact high of this market move. Never hear me say that. But I will look for these two things to help me get cautious near a market top. If the least that I can do is to get cautious near a market top and say, you know what, time out, let's not add any more inventory right now. Time out. We're looking a little top heavy right now because there's these two things that have told me to be cautious. Number one is, and some of you have seen this chart before, but this is the monthly chart on the left-hand side, and here's the weekly chart on the right-hand side. These are the same chart. This is the S&P 500, and this is generally what I look at to determine what the market is doing. I don't use the Dow for that. I don't use the NASDAQ so much. Don't use the Russell 2000. Don't use the Wilshire 5000. I use the S&P 500, which is probably the most watched, best arbiter for value in the U.S. stock market right now. So what I'm going to do is I'm going to look for confluence. Now, what is confluence? Confluence means that when we have more than one thing showing the same thing at once, where it's like they're heading in the same direction. If you're rowing on a crew team, you want confluence. You want everybody rowing in the same direction, right? And ideally at the same time. Confluence is something that's very important. This is where you get the power. So in other words, if you get something like this, you get a massive energy spike here on the monthly chart. If we have the same thing showing on the weekly chart, we're about to get a huge move, depending on which way it's going to go. So now I need to look at the converse of that, right? When do we have a situation where we have, and this is particularly good right there, this one was massive. This, we had exhaustion like to beat the band here at the end of 2017, early 2018 for the first 3 or 4 weeks of January in 2018. And you can see how the price just went like that. We had confluence. We actually had the monthly and the weekly chart beyond exhausted. And at that point, I was just throwing my hands up and I said, I can't do anything about this. I can't take anything long. We've sold our longs into strength. We don't have anything anymore. And it was frustrating because for a couple of weeks there, I didn't have anything to do. I can't place a trade in this condition. And then I remembered the actual day where the market just trashed itself was in early February that year, at the beginning of 18, just trashed itself to the downside. I think this was like an 11% move, and it hit that in almost about a day and a half. And I had nothing at risk. I didn't care. And I was traveling during the day. Usually when you're traveling, you can't get to it. You're panicking. You're trying to set up your phone in tether mode so you can get on with your laptop and make a trade. I had nothing. Did I time the top perfectly? No, I didn't. I was weeks off. But I had become cautious because of this crazy exhaustion signal that showed up actually several weeks before that. So there's just times where you can't. Now, there's different ways that you can handle that. You can get rid of your big positions. You can trade small. And you can trade long, because what you'll find is the biggest gains in the bull market come at the very end. Just like the biggest losses, the biggest selling comes at the very end of a bear. Always. So you can get rid of your big positions and just trade something small. There's various different ways to do that as well too. But monthly and weekly fractal energy exhaustion confluence is a big, big deal. Number 2. This is stockcharts.com. All of you can get this for free right now. If you go out to stockcharts.com and start typing in, it's actually the $SPX A200R. That's the ticker that's out there. And what I'm doing is I'm setting this for weekly. So right off the bat, you'll see the daily one. I'm setting this for weekly. What I'm looking for is divergences. Now, a divergence, some of you may or may not know what this is. A divergence shows up when we have the price doing this. This is a negative divergence, by the way. And then we have the indicator that we're looking at doing this. So while the price is going higher, some form of indicator is going lower. Now, this goes way back in my education. I was reading Alexander Elder, Mr. Trading for a Living. This is that Russian dude that jumped on a freighter and hid away and basically, sought asylum within the United States. So he's got an interesting backstory, but he's been around for, 20 some years in trading education. And one of his strongest signals was the MACD histogram divergence signal like this. Now, I believe that in today's market, this can get a little bit swampy because you can see MACD divergences going on forever and ever and ever because we have unlimited money that's out there. And so the markets operate differently than they did 20 years ago. But this one still works. And this is another cautionary signal. And the one that I want to show you here is from the beginning of 2020. Markets at the time into actually the third week of February were actually still going higher. Look it up. I think the market topped out on February 20th of last year, which is a year ago, right? Topped out, but what was showing on the weekly chart of this study was that we were making lower highs. This is a pretty clear divergence. What does this mean? It means that fewer stocks are above their 200-day moving average. So what was happening is the market was kind of coasting along, and it was being driven by very few, very large cap stocks. And that is very typical. We've had that for a long time now, where the rest of markets will top out and start trading below their 200, which implies a downtrend. The price of an asset starts trading below their 200-day moving average. That is not strength. That is a transition into a downtrend. So we had more and more stocks transitioning into a downtrend, but the price is going higher. How is that possible? It's because of the way that the S&P 500 is structured, where it's driven, I believe 25% of the value of the S&P 500 is concentrated in only 5 stocks. And so if you got Google, if you got Facebook and Microsoft and Apple and Amazon driving higher, and now Tesla as well too, meanwhile, everybody else can, be starting to downtrend. And there you go. Hey, Marcos, how you doing? So that is one that I will look for. Is it a timing signal? No, it's another cautionary signal. It's a signal saying, whoa, time out. Whoa, we got divergence showing up on the SPXA 200R. So between these two, am I going to get a perfect timing signal? Not on your life. Can't do it. But that's when I become cautious. Now, what are we seeing now? We're not seeing quite the same thing. We're not seeing any kind of measurable divergence. It's slightly lower, but it's not yet at the level which I would start to wave the white flag and say, oh, I think it's time to get out of here. So remember, you'll never time this perfectly, accept it. Please do that, and please stop looking for the magic study that will mark the exact market top. There are none. It's called price. So if you liquidate, find something else to risk very little before the ultimate top so that you're not a bag holder, right? Nobody wants to be a bag holder. And just in doing this, you'll be so far ahead of everybody else that it's going to take it in the shorts on the next, like this is, right now, this market is, we have had we've just about, I wouldn't say doubled, but man, off of the March low, look at this. We've gone from 2,200. We've just about doubled the S&P in 12 months. 11 months, actually. In 11 months, we've just about doubled the S&P. So what's happening here is that you're seeing, this is called a broadening pattern. It's a megaphone pattern. The volatility is expanding. What does that mean? It means that markets are becoming more unstable. For those of you that have driven in the snow, anybody here driven in the snow, right? So if you're going to if you're turning out of this street and turning left, onto an icy and snowy, you're not going to make a very crisp turn, are you? So what's going to happen? a lot of times you'll turn out and you'll overshoot and you'll have to recorrect like this. And if you're able to, set up a declining pattern like this, and you're able to gain stability of this. But what's likely to happen for newer drivers is that they will do something like this. They'll oversteer, overcorrect, and that's where people crash. So markets are set up for a really wicked next move to the downside. That's not a prediction. That's just more looking at the volatility. That's looking at how things are moving right now. Does that mean that I'm bearish? No, because we're not finished yet printing the upside move. Okay, see, Salas, I'll get to your question at the end of the prepared remarks here. Okay, so the next question, anybody have any questions on that before I move on about spotting the top? It's a huge topic. It's something, it's like playing golf. You'll never perfect it. You can get pretty good at it, but nobody's ever going to shoot 18 on a golf course with 7,000 yards. Nobody's ever going to do it. And nobody's ever going to hit 18 straight hole-in-ones. It is not possible unless you're playing some kind of executive course and you're shooting out of your mind, right? So this is something that we should strive to be better at, but understanding that we'll never be perfect at it. Okay, so nothing seen. I will go on to the next topic. So cash secured puts on a pullback. And I'm hoping that you guys sort of know what a cash secured put is, but if you don't, please don't tune me out, because this is a very, very important topic. Something that you should learn. Can you provide the reasoning why you want to enter cash secured puts on a pullback? Okay, off we go. First off, you got to understand what a cash secured put is. When we sell the put, so basically what we're doing is the price is moving up here, and we will choose a put that has an expiration date, and I'll represent this expiration date as some date and time that's out there. And what we're going to do is we're going to sell this put option below the price, somewhere down here, and I'll just represent this as the strike price with an S, and we will get money going directly into our account. As soon as we enter the trade, we get a credit for that. Well, lately we've been getting some pretty good credits on these. So what we're doing is we're obligating to buy the position down here. We're obligating ourselves to buy the position as it comes down to this level here. As the price comes down by expiration date to this strike price or below, then we'll be on the hook to buy the stock, which is what we wanted to do in the first place. We just got paid to enter this on a pullback. What could be better than that? Now, typically what we see is we'll see the price pulling back and we'll enter at some kind of pullback down here. And then what we'll normally see is that the price will, over the course of the 4 to 6 weeks that we trade it, eventually it reverses and goes back. And then we can close the trade for a very, very small debit and release our obligation. And then we'll just do it again. So this is what a cash secured put option is. And it's one of the simplest and most powerful option strategies out there. Everybody needs to know how to do this. This is how Warren Buffett has made the majority of his money. So this is not always true in how the trade plays out. And what I mean by that is that, let's say we have that expiration date, or let's use the same color here. We have this expiration date, and we have the put that's down here. And if the price is going to do something like this, if the price is going to come down to here, we can ask ourselves, do we really want to be assigned at that level? Or can I roll it further out in time at a lower strike price? So we may do that. That's an option to us if it makes sense to do. So I used to lose a lot at this strategy because I'd get cold feet. The minute that we'd start to see red tape and negative price action, I was like, ooh, I'm gone. Let's shut this down. Let me limit my losses. And that's because I wasn't reconciling. I was not okay with being assigned. And once I started being okay with being assigned and started to understand how to really play the strategy, I did much, much better with it. You've got to have a strong commitment on the stock to play this strategy. So what are our goals for selling a put option? Got 3 goals here. To get the lowest possible assignment price, I want to buy this at a discount. Never, 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 never with a capital N, just ape into something that's going like this. So you never want to just ape into a stock which is going parabolic. You will pay for that. So for those of you that are playing CCIV, Churchill Capital, which is all the way down here now, that one doesn't feel very good if you aped in at those prices. If you just bought the long stock at those prices, no good, no bueno. So we want to do something way down here where I'd say, well, I'd be a buyer if it was a discount. We all love discounts. Number 2, with a decent amount of credit that makes the trade worth the risk. So I want to get paid for that. I want to be paid well for putting my capital up for assignment. And I used to say I want to make at least 1%, but in today's market with the stocks that we can pick, which are cheaper and have a lot of implied volatility, typically I'm making 4, 5, as much as 10%. We just closed one on CCIV for, I think, 12 or 13%. Crazy stuff. Get some. And a credit that dramatically lowers the cost basis of ownership. So in other words, if my strike price is here, if I earn a specific credit, so if this is my credit, which is this distance here, this is my cost basis. So in other words, if I sell the $17 put on something, and if I pull in $1 worth of credit, then my cost basis equals 16. Right? Makes sense. So not only do you get paid for the pullback, but you have a little bit of insurance that comes along with that credit. So all kinds of good reasons. So to maximize our entry, we want to enter this trade on a pullback in an uptrend. And not as the price is not as the price is running away. We don't want to enter these. Now, I've done these before on some of them that have just left a base. If they've just left a base and all of a sudden they're taking off like this, sometimes what I'll do is if there's enough implied volatility, I'll still sell down here. If I'm able to get the strike that I want to, I'll still do it. But it's not anywhere near as good as when the price actually pulls down and starts pulling back like this in the context of an uptrend. Has to be in the context of an uptrend. So I will step in front of that freight train coming back down, and that allows me to get something which is much deeper, usually down here, wherever that is, right? It's deeper because implied volatility is rising as the price is going down. CCIV is the only time I've ever seen something like that happen where the price is dropping like a stone and the implied volatility is coming in. Never seen that before. And it's only because the event is over. Occasionally you'll see something like that with earnings, but very rarely. So again, we can examine the charts and chains here if you want to. Let's see what we have to look at here. I mean, we could look at CCIV here if we wanted to. This would be a good example. And then we can get to Salas's question. Okay, so price is pulling back. Now we don't have necessarily, so this qualifies as a pullback in an uptrend, believe it or not. But what we could do, oh, we got a nice, look at this. The S&P is up for the day. How about that? Everybody, for those of you that are panicking, we actually have the S&P up for the day. I love to see hammer candlesticks. We'll look at that in a minute. All right, but if we're looking at CCIV, if March is too little, we're looking at the April options now. I can get paid at least $1 or $100 a contract selling at the $20 strike, which is down here. So would you still want to be an owner at the $20 strike? In my mind, I think CCIV is probably over with now. It's probably on the downhill side of becoming an IPO. And I would probably wait for the IPO to hit because there's usually a pattern to this. Actually, Charles wrote this out in one of the SPAC articles lately that typically we see something like this happen to, there's the speculation about the merger, then the merger news comes in, and then maybe you get a little pop on an IPO, and then you get another, jump to the downside here before this thing stabilizes and then eventually becomes something. So we've seen that a lot with, let's see, what do we have? Like Lordstown Motors went through this. I think finally went IPO back around here, something like that. And then eventually sold off. But then, it's starting to find its footing. But this is just in a huge pattern right now. But we're seeing the same kind of things. Right? Hopefully that helps. Coob, does that help at all? You had the original question here. Let me know if that answers it or not. Or if I need to add any color to that. And then while you're doing that, while you're responding, I'm going to answer the CCIV question. I've made a ton on the way up. I have my last small tranche, 10% of original purpose. Should I just take it out now, or do you think we'll have one more push up? So I think what you'll see, and again, this is not financial advice, and I'm not allowed to tell anybody. A 21-year-old kid with a Series 7 is allowed to give you financial advice, and I am not allowed to give you financial advice. So I can't tell you what to do. But based on what we've seen here, typically we will see the same kind of things. Like this is a sell the news reaction. Buy the rumor, sell the news. This is classic. This is like, you can't come up with a better example than buy the rumor, sell the news. Okay, so that's there, but I believe usually there's a little bit of interest into the IPO. So I don't know when the IPO date is at which it becomes Lucid Motors. It might be a month, it might be 2 months. I don't know when that is. Maybe you guys know better than I do. But once that hits, usually there's a little bit of a hangover from the IPO, kind of like, oh, okay, well now what? Now it's a real company. Now we have earnings, and now they have to go build the plant, and they have to go hire people and spend all the money. So it's kind of like Christmas morning where the kids play with the presents for like a good solid hour, and then 2 hours later, they're playing with the boxes that they came in, right? The bloom is off the rose. The excitement's gone. It's like, oh, let's play tackle football with the cardboard. Oh, I like that. I like that. Always keep a moon bag. That's great. 10%. I mean, it's you've done well to lock in a lot of profits, and I'm glad that you got out before the news hit. Okay, so Coob, looks like you're better now. Okay, and always, if something doesn't make sense, let me know offline, and I'll be happy to walk you through it. Yeah, from your desired entry price, the credit will go. So what you're talking about is if this is an option that you sell, and let's say this is time down here. This is time, and this is the value of the option. When you sell that option, it's going to start melting. And it's going to go like this, and then near expiration, it's going to go like that. It's going to dive down to nothing. So imagine that you have an ice cube in your hand, and the camera that I'm looking at is a fire. So the closer and closer that I get to this camera or fire, the faster the ice cube melts. And that's the same thing that happens with expiration. So when I sell a put, and we sold a $20 put down here on CCIV, I said at the time the price could go higher, it could go sideways, and it could even go down somewhat, and I can still win on the trade. That's what I love about this strategy. So you're starting off with at least a 67% probability of success. And even if you do get assigned on it, then you can turn right around and play the wheel strategy, which is to sell covered calls. Okay, guys, we've gone our 40 minutes. This is about where I thought I would finish up here. So unless there's any other questions, let me know if there's any final parting shots over the bow here. I'd like to thank you guys for showing up today. And I think we are good. So, love to see you next week. We'll do this at the same bat channel, same bat time. Look on YouTube. We'll publish this on YouTube, as well as we'll put this in the 10X Tribe. If you are watching this, you are not a 10X Tribe member yet, please consider doing so, because it doesn't cost you a thing. It doesn't cost you a thing to get in the 10X Tribe. And, you know, we publish stuff in there all the time. We have, look at this, we have trade alerts in here for free. And we tell you how to take those trades and what to do with them. So this is all for free. We publish articles. We put courses that are out there for 10X Tribe members. We're just trying to get a community together of like-minded traders. We're sick of all the crap that's out there, all the raging this and raging that. And, you know, it's crazy. I've been doing this long enough. What I wake up with and want to do every single day is to help people. It's in my nature. It's what I love to do. I love to get people excited about this stuff and change their lives. So join us at the 10X Tribe. And if you want to take it up a notch, join us at Elite, because we have a live trading room every day. All right, folks, thank you very much. I want to thank everybody for showing up today. And that is all we got. So thanks, everybody. You guys take care.